Well, welcome to Current Yield, Grant's Interest Rate Observer of the Air. I am Jim Grant, and with me, as always, is the great Deputy Editor of Grant, Evan Lorenz. Good afternoon, Evan.
Good afternoon.
Yeah. So I am calling in from Schoharie, New York, which is 35 miles or so west of Albany and about as many east of Cooperstown, New York, home of the Baseball Hall of Fame and of the Glimmerglass Opera. And let's see, what other advertising things we may... Oh, yes, this podcast is brought to you by, as always, in this difficult time of pandemic, by Love and Youth in Spring and by the October 19th Fall Grants Conference. Evan, I think it's going to be a fabulous conference, and if people don't get their tickets today, there might not be any seats left. That's my vision. I don't know.
I agree. Hot destinations are selling out fast. People should buy now.
Yeah. And also, we have a third sponsor whose name is John Delberto. John is our telephone sales agent. And ladies and gentlemen, when he calls you to subscribe to Grants, would you please say yes? It will make his day. He asked me to mention that. But we have a guest today. It's not just Evan and Jim, complaining about the markets. We have with us Paul Brodsky. And Paul is a man of parts on Wall Street. I knew him way back when he was focused on the gold market. And the two of us had lunch late 2016 or early 2017. We had lunch in Harry's Wall Street, way downtown, lower Manhattan. And I blame the acoustics in Harry's, which were horrific, for my failure to pick up on what turned out to be a magnificent business opportunity that Paul was only too happy to lay at my feet. And would I listen? I tried to, but I couldn't hear it. Paul was telling me about the coming thing in the cryptocurrencies, and Bitcoin in particular. He was going to go off and participate in this coming thing. And so time passed, as it is wont to do, and Bitcoin had up and down. So it had a great up and then a rather striking down in the crypto winter of 2018. But I want to read you something that Paul Brodsky wrote around September 12th or so of 2018. Bitcoin was then trading at about $6,300 per per it is. What is it? Oh, we'll find out. Anyway, it was $6,300 per, and I see today it's at $63,000 per, which is that's up some from 6,300. Okay, so here's what Paul wrote. He wrote most strikingly, he said that the thing to do with Bitcoin is not to focus in your compulsive left brain about what the discounted future cash flows might or might not be. The thing about paradigm shifts is that what counts is adoption, not visible value. It's something else. That is what drives paradigm shifts. And he quoted Supreme Court Justice Potter Stewart saying that, famously, as Potter Stewart said with respect to pornography, I know it when I see it. And what Paul knew is what he saw, which says that Bitcoin was going to be a thing. So with that somewhat prolix introduction, Paul Brodsky, welcome.
Well, thank you. It's great. It's a great honor to be here always. And even if it weren't a podcast, Jim, it's always a pleasure to speak with you. I learned so much just from spending a couple minutes with you. And about that comment, what do they say about even blind squirrels find nuts every now and then?
Well, we'll see about
I can't take a 10x your money credit every day, so I'll put it in my pocket. But happy to move on.
Okay. So Paul now is the chief cook bottle washer of something called PostModern Partners. Now this, Paul, I got to confess, this is a little difficult for me. I'm not so keen on modernism. Now, postmodernism, it sounds, well, but anyway, so we're not going to talk about up tenfold, but we will mention that as of the March reporting date, PostModern Partners was up between 31 and 32%. But, Paul, what I like most about the many things I like about you and PostModern Partners is that you are no more a fat fiat cat than you are a crypto nut. Those two extremes were featured in the aforementioned essay of September 2018. You are a markets guy, right, who sees excess as Justice Potter Stewart would have us see it. You know it when you see it. And I want you to tell our listeners how you see this crypto world now. It seems as if it is going to heaven.
Well, I think there is certainly, the pain trade is still higher. And by that I mean, in all likelihood, cryptocurrencies led by Bitcoin are generally going to go up over time, in my opinion, because there is just a paucity of investors that potentially could get in, and there's a lot of billions probably to access the market. If we fall back on, and please interrupt me because if I go into a place that doesn't strike your fancy, but if we go into valuation, and that's always a dangerous thing to do when it comes to cryptocurrencies, but we start to talk about valuation or metric even, how we like to value other more traditional asset classes. It seems to me that Bitcoin per se may have a linear return profile in this cycle. And so,
now, what is a linear return profile? It sounds bullish, but what is it?
It can certainly, the price of Bitcoin can certainly go higher, but it can certainly go lower. And this profound background.
Okay, Will, thank you very much for being with us today, Paul.
As profound as that is, I think as it sits right now at 63,000 or so, it can certainly double in this cycle, but it can just as easily drop 50%.
Yeah.
And so you're not really investing, in my opinion, of course, in an asset with an asymmetric profile, return profile to it, which has always been the reason to get into crypto. I think there are other cryptocurrencies in the space that still do have, vastly positively asymmetric return profiles to them, and so they make more sense than Bitcoin. But certainly Bitcoin.
Well, let us stop there, Paul, and I would like you, for the benefit of our listeners, to name those. Save the best one for later, and we'll put it in Grants so that the paying customers can read it. But give us the pretty good asymmetric return cryptos.
Well, okay, I'll give you a few, but what I'd like to do is paint a broader picture of the 2,000 or 2,500 or 3,000 frauds and silly cryptocurrencies that are out there that either went to zero or on their way to zero. Many of them came out in 2017 as ICOs, and we all know what happened to them. What remains and later ones that have come to market really are more infrastructure-based, meaning they actually will provide investors in the cryptocurrency market with the means to access or to buy, to sell, to lend in what's known as decentralized finance or DeFi, things along those lines. But what I am focused on for PostModern Partners is more infrastructure plays, because that early time in the cycle when you can buy effectively picks and shovels for the crypto market. Example.
Yeah. Oh, sorry. Go ahead, Paul.
We've all heard of Ethereum. Ether is the largest. It's the second largest crypto behind Bitcoin, of course, but it has a $200 billion or higher market cap, so it's significant. And it is the leading candidate to allow developers of smart contract cryptocurrencies to develop their use cases and applications and distribute them to users. We can get into that. Ethereum faces a number of hurdles to get the technology right, and so it's not yet ready for prime time. One of the big ones for Ether, which is the crypto of Ethereum, and the others is that all of this stuff, all of these cryptocurrencies don't yet work at scale, meaning you can walk into a Starbucks and you can, even these days, swipe your smartphone and buy a latte with your Visa card and a QR code. You can't do that yet with a cryptocurrency. And the reason is because on a blockchain, the last block has to be immutable. It cannot change. That's opposed to a fiat credit-based currency system where everything is done on credit, and what they're doing when you swipe your card or your smartphone at Starbucks is they're taking your account information. If you don't pay or you don't have enough money in your account to pay for your latte, well, it's bad on them, but their 21% interest rate will probably make up for that. No one really cares. That can't happen on a blockchain because there's no intermediary. There's no banking system, and so everything has to be immutable, all the data on the last block. So it sums up the works, and that's why transactions per second, TPS, which is the metric by which this technology is judged, is much, much slower than a Visa or MasterCard payment rail. They will do 20,000 or so transactions per second. Bitcoin or Ether payment rails would do 7 or 16 or 20, and now it's getting up into the hundreds, but it's still not ready for prime time. So there's a lot of wood to chop for many of these cryptocurrencies to be able to compete on a transactional basis.
Evan, haven't you quoted some figures with respect to Visa?
Yeah. So a single Bitcoin transaction consumes the same amount of power as 966,202 Visa transactions. And in terms of speed of processing, in late March, Elon Musk allowed Tesla buyers to use Bitcoin to actually put down a deposit for a Model Y or a Model 3. I'm going to quote a tweet from March 29th. Elon Musk, thought I'd be hip and pay my Model Y deposit in BTC, but my crypto app took longer than Tesla's half-hour window to send. Now the BTC seems lost and no one is able to help.
Yeah. Well,
nightmare. Yeah. It's not. It's clearly on a number of different levels. It's not yet ready for transactions.
Who would? One of the tests of the functionality of a currency, of course, is the willingness of people to spend it and to borrow and to lend it. I'm still waiting for the first volunteer to take out a Bitcoin mortgage. It does. Yes, sir. It seems that your mortgage, which you took out unwisely, as Paul Brodsky was telling you what the future would bring, that mortgage at $6,200 Bitcoin is now you owe 10 times as much. And would you please pay the coupons? So how do we, Paul? How do we, in a more serious note, how do we deal with the seemingly inherent, or is it inherent, volatility of Bitcoin and the clunkiness of the transactions function? How do we think about those things in the context of a useful currency?
Oh, it's not a useful currency yet. So we can't yet think of it as a useful currency. I think what is going on today is the cryptocurrency market is in the process of capitalizing itself. And it's doing so on the basis of speculation. Obviously, it's just being driven by demand. Bitcoin, as the first, been around, 11 years now, something like that, 12 years, coming up on 12 years. It was the first, and it already has experienced its network effect. Depending on who you listen to, it has anywhere from 75 to 100 million holders around the world. And its use case is not as a transactional currency, but it has become digital gold in the minds of its holders.
Well, sorry.
Well, what I was going to say was, Jim, you and I have been are intimately familiar with gold and what it is and what it was and what it's been relegated to today. And a digital gold doesn't have to prove itself to anyone except those that believe in it. And clearly, Bitcoin already has its faithful. So all it takes is confidence that it will continue, its store of value will continue to rise. And many of them hope that it's at a very volatile, that it's very volatile, not boring. Because they are not looking at Bitcoin specifically to be a transactional currency. It may develop into that down the road, but it's nowhere near at equilibrium where it gets to be a boring currency.
It's I would submit, Paul, that Bitcoin's base case is going up. That's its functionality, and that the value guys like to use this phrase, intrinsic value, which is, I guess, means the value outside the market price. But isn't Bitcoin's intrinsic value identical to its market price in that it has become one of the great speculations of the still young 21st century?
I don't think it's any more. I think its intrinsic value is no more or less than any other asset that doesn't generate revenue and earnings, such as the dollar, such as gold. And so, yeah, it's just based on where supply meets demand.
Right.
If you were to go into the dollar, and I don't think this is a very tough sell for you and maybe the majority of your audience, if you were to look at the intrinsic value of the dollar, you'd say, well, that's okay. If there's 100, depending on how one counts, there's 75 trillion or more of dollar-denominated debt here and around the world, based off of a $3 trillion annual revenue that the Treasury receives. So it looks overvalued on that intrinsic value calculation too. So we can tie ourselves in knots, I think, by trying to look at intrinsic value on a currency or any asset. But you know, I wouldn't defend intrinsic value in Bitcoin, other than to say it is what people want it to be, just like the dollar, just like gold.
You know, you might not, you remember, I'm not sure if every listener knows that in February, Grants had a long piece about Bitcoin, quite bearish, quite skeptical. And the headline was, Bitcoin goes to Wall Street. And it was about the financialization or the domestication of Bitcoin. And you know, he said it was a bubble. And you wrote, as is your wont, a very thoughtful and civil email saying that how much you enjoyed this. And you added that with respect to the bubble, you said, actually, I can think of a bubble perhaps even bigger, which is, you enumerated some of the financial bubbles that have been sponsored by, or at least our central bank has been complicit in, if not as actively sponsored as we, for example, sponsor the autumn 2019 Grants Fall Conference. You know, apropos of that, I would like to read for Evan and for you and for the listeners a comment attributed to Chair Powell yesterday with respect to Bitcoin. He was asked about it. And he said, quote, says the Financial Times, quoting him, no one is saying that for payments, for example, like the dollar, the Bitcoins, and he said, quote, it's a little bit like gold, close quote. And I think that's a great way of getting everyone mad at Jay Powell. You know, the gold guys were mad at Bitcoin because it's stealing all their thunder. And now the gold guys and the Bitcoin people can find common cause, again, in this fellow who seems not to realize that it is the good part, the actions of his institution, that have driven the masses into alternatives, no?
Well, I think what I've been, you know, I clearly was a gold bug from 2000. Maybe it's not so clear, but I was from 2000 through. I still own gold today, actually, and did a lot of writing on it and invested in it professionally for a long, long time. So I'm very sympathetic to the gold story. I think that one of the things that we have to realize is that all this thing is, you know, all this whole cryptocurrency thing is an extension of the internet. It is software. And if the cryptography, and I'm not a technologist, but I understand if the cryptography is sound and the custody is okay, it is another bearer asset like gold, like bullion, that you can store, and that if the Fed and other central banks continue on their merry way and diluting the purchasing power of the dollar, then both should rise. And as long as Bitcoin is a bit more nascent than the 5,000-year-old gold is, then it should probably rise more than gold, but they should both benefit. The fact that Jay Powell doesn't or won't acknowledge the Fed's role in creating the diminution of the purchasing power of his currency should be nothing new to anyone. Where I was disappointed for many years and remain disappointed is that people don't seem to care.
Yeah.
Investors don't care. Consumers don't care. Savers don't care. And that's because I think there's a very cynical and, frankly, effective process that has been going on for at least since the financial crisis in 2008 and its reaction in 2009, where all you have to do is give savers a better return than consumer inflation, and no one will be the wiser. It's terribly wrong, in my opinion.
Okay, but let me with respect to the appeal of Bitcoin as a monetary alternative, not so much as a hedge against monetary disorder, but an investment in monetary disorder. I want to direct your attention, Paul, and your attention, Evan, and your attention, listeners, to remarks made at a congressional hearing just the other day by a guy named Michael Morell, not a guy like Mr. Michael Morell, who's a former acting head of the CIA. And Mr. Morell was commissioned by some cryptocurrency innovators and investors to investigate the contention that Bitcoin is kind of is criminal script, that it still principally uses to buy that surface-to-air missile you couldn't buy at Amazon. You get that in the dark web. So Michael Morell testifies that no, that whole narrative of Bitcoin being the criminal's favorite monetary brand, that's all wrong. It's much, much inflated. But here's what he did say. He quoted his contacts in the surveillance and the national security line of work, saying, quote, "It is easier for law enforcement to trace illicit activity using Bitcoin than it is to trace mass cross-border illegal activity using traditional banking transactions, and far easier than cash transactions." And he goes on to say this. This is from an article on which his testimony was based. "One expert told us the chance of catching illicit actors is magnitudes greater using blockchain than the traditional banking sector anywhere." Another went so far as to say that if, quote, "all criminals use blockchain, we could wipe out illicit financial activity," close quote. So my question to you is, given that one of the great selling points of Bitcoin was anonymity, blockchain anonymity, it seems as if the national security apparatus can see right in. So it's like having your divorce bonds, as bearer bond used to be called, in a safe deposit box. But the feds have the number of the box. So what exactly is the appeal of the blockchain for those who would prefer to transact anonymously?
I don't think that the great majority of holders today care about anonymity at all. Most are accessing crypto platforms that have AML, KYC, know your customer laws, and that are reporting to regulatory agencies around the world. And while there may be some remaining bad criminals that want the authorities to be able to trace their actions on the blockchain, I don't think that's really the appeal and where this is going. There's still nothing better than a bag of cash for an illicit transaction. And so I don't think really the appeal or the success or failure of blockchains and cryptocurrencies are going to have anything to do with anonymity at all.
Paul, could I ask you a question on the plumbing of cryptocurrencies?
Sure.
So, while Ether and Bitcoin are the biggest cryptocurrencies by market cap, they're not the most traded cryptocurrencies. That's, in fact, Tether, which is supposedly backed 1-for-1 with dollars. There's been a lot of skepticism about it, and they recently had a settlement with the New York Attorney General. And in that agreement, they seem to have some alarming facts about Tether not always being backed by dollars, also moving money to and from accounts and to sister companies. Is Tether something that people should be worried about?
Tether is something that I and my former firm, where I was a partner at Pantera Capital, never dealt with. We didn't know it. There are but a lot. We couldn't get to the bottom of their balance sheet. and didn't understand it, shall we say. And so, they could be totally fine, but there are other stable coins out there that have a better chance of, and more transparent, that have a better chance of maintaining that dollar peg, if that's what you're looking for. And by the way, for those that aren't familiar with why there needs to be a stable coin, it's just for what Jim was talking about earlier, which is the fact that you don't want to pay $10,000 for a couple pizzas down the road because your currency goes up, 10 times or 100 times or 500 times. So it's for transactions. You convert your crypto at a dollar rate, and it'll stay at a dollar rate. So that's pretty much what that's all about.
Paul, you go long and short some of these crypto names. You'd be long or short Coinbase?
Neutral, but I think I haven't done a deep dive, to be honest, into its balance sheet, income statement, and frankly, it's way too early. What you said before about scaling, the first thing you described about adoption, there will be plenty of adoption, so it's really tough to put a valuation metric on it, as it is a smaller new tech stock or fintech stock that proposes to scale. So,
how about MicroStrategy, long or short?
I dislike MicroStrategy. I have been shorted against a long Bitcoin position. It's worked out for me. Sometimes you can take advantage of a bullion in the equity market, and certainly that was the case. And maybe still, when you have investors using common stock as a proxy for Bitcoin, because it's the only thing they can access. And so I'm not a fan of MicroStrategy.
What are your thoughts about Grayscale Bitcoin Trust discount to NAV, which is now, I think, around 10%? It seems like a pretty commanding discount if Bitcoin is still going up.
It could be telling, but it may not necessarily be telling of sentiment. And the reason is because Grayscale opens and closes its window, and so it's tough to get a handle on that. Obviously, when it traded for years and years at a 30 to 50% premium, it was a head-scratcher. It recently went down to a discount, as you point out, and probably the reason has a lot to do with competition. MicroStrategy, when it came along and became a proxy, that was obvious competition, and there are going to be others, and there are now advertising on CNBC. Osprey, I think, is one. So there's good reason to see it. One has to be pretty familiar with fees also when you're looking at gaining exposure, long-only exposure through one asset. And so I think that if and when there is a Bitcoin ETF, the entire complex of the cryptocurrency market will shift dramatically.
Paul, finally, Judge Potter Stewart said that you know it when you see it. Could this be a bubble? This whole thing be one big bubble?
Yes, but it could certainly absolutely be a bubble. I don't think Bitcoin as digital gold can go to zero unless they shut off the internet or unless they raise taxes on Bitcoin around the world to be some 70 or 80% of gains or something like that, or they make it illegal. But in the context of other bubbles, like the dollar bubble or the global credit bubble or the mass financial ignorance bubble that we talked about before, it seems to be a small bubble. So I don't know if it's any more unsustainable than the combination of an unanchored, flexible exchange rate global monetary system and going along with negative real interest rates.
Now there's your concave bubble.
And inflation targeting and MMT and saving and market priced assets. I mean, all of that seemed at least as ridiculous to me as, trying to store your money in software rather than, or at least diversify it into software that is in the process of capitalizing itself and may someday actually bypass a lot of the banking system verticals that we've come to know and love. That's the promise of it, and it's a speculation, but if it works, it can really scale from here.
Yeah. Well, Paul Brodsky, what a pleasure it is to be with you on this podcast, and best of luck to you and to PostModern Partners. Although I think, by the record, you don't need much luck. Just keep on, keep on keeping on.
No, thank you very much, Jim and Evan. I appreciate your time, and it always takes luck. So.
Well, then here's to luck, and here's to you. Here's to you, listeners. We will be with you again on Current Yield, Grant's Interest Rate Observer of the Air.